Hi, everybody. This is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, August 2nd, 2025. Hey, I hope you're doing well. I hope you are having a good weekend. I hope you had a good trading week last week, and I appreciate you coming to my weekend review podcast. I hope you are going to find it helpful. I think I have some good things to go over today and some good things to teach. So first of all, last week we had a lot of changes in the market from a technical standpoint. And during this podcast, in addition to going through my trades, I will be talking about what has changed and why it's significant as far as how I at least am going to approach my trading. So I hope you're going to find that helpful. So the format for today is, first of all, we are going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades, all the positions that I have, all the trades that I entered. We'll talk about when I entered them, why I entered them, what the signals were, what the confluence of signals were of why I got into the trade. We're going to talk about how I position size. We're going to talk about how I place my emergency stop, how I place my end of bar stop, how I take partial profits if the market gives them to me, and then how I go into trailing stop mode, and then ultimately how I am going to exit the position. So I had a good week last week trading, and like I said, I'm going to share all those with you, but we'll look at all the positions that I entered. We'll see how they're doing. We'll look at all the positions that I exited, how I did on those as well. So hopefully this will give you a good idea of how I view trading, the particulars, factors that I need in place before I take a trade, and how I execute the trade, get in, get out, whether it's a profit or a loss. After that, we're going to talk a little bit about trader psychology. The most important thing in trading, I've been trading for over 30 years, is the ability to create a plan, and more importantly, to follow the plan. Whether it goes your way or it goes against you, it's fine. We need to look at every trade like just one trade of the next 1,000 trades, not to put too much emotional energy into one particular trade. One particular win or one particular loss isn't going to shouldn't change your life, right, or your financial situation. We are, or at least I am. I have an edge in my trading. I know over time I will extract more money from the market than I give back to it. But in order to do that, I need to have a good trading plan. I need to have a good trading process, and I need to follow it. And that all comes down to trader psychology. So we'll talk a little bit about that. I hope it's going to be helpful for you. After that, I have gone down through my master watch list. I do this every Friday night, and I am looking for potential setups for next week. And there are quite a lot of them. And I will go through and I will show you. But in general, I like to do this on Friday nights, and I look at a chart and I say, okay, in an ideal world, if this particular stock comes to this level, then we'll have these confluences of signals. Maybe we'll have an order block. Maybe we'll have a major deep dip by moving average like the 200, 250, 300. Maybe we'll have a 30 RSI. Or ideally, we will have a combination of those. So that's what I'm going to do, or that's what I've done, and that's what I'm going to share with you today. I think on the dailies, I have 10 potential setups, and they may not get there next week. And if they don't, I won't take them. If maybe all of them are going to get there. If they do, does it mean I take all 10? No. I only take one trade per day. But there are some interesting setups coming, especially in light of what happened last week with the big move down on Thursday or Friday. We could essentially call Thursday a blow off top. So a lot of things have changed. And, the market, especially with the momentum driven tech stocks, um, you know, some air has come out of that trade, and it changes things, which is good because it gives an opportunity to possibly get back in these. So I'll go over all of them on the daily and the weekly, or the setups that I'm looking for next week. And I hope that will be helpful for you. And if anything is helpful to you during this podcast, if you've learned something or it's of value, I really would appreciate it if you could hit the thumbs up button. Really helps out the channel, lets YouTube know there's some valuable content here. And if you haven't subscribed, I would really appreciate it if you could subscribe as well. So first of all, let's get this U.S. legal disclaimer out of the way, and then we'll get started. So hang tight.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, well, let's get started. So first position I have here is McDonald's. I'm going to spend a little extra time on this particular setup just to show you all the basics of everything, and then as we go forward, I won't spend as much time on each chart, right? Just in essence of time. But here we go. Here's McDonald's. I got long McDonald's on the 26th of June. This is a deep dip buy along with a V1 entry. So deep dip buys have to do with the test of the 300-day moving average, the 250-day moving average, or the 200-day moving average. When I bought this here on the 26th, and I bought this at 285.61, you can see the orange line here. This is the 300-day moving average. This is a key level that large financial institutions and savvy traders key off of. So on the particular day that I entered it, during the day, it went below the 300-day moving average. At the end of the day, it closed back above. So it essentially, the price tested underneath the 300-day moving average. There were no more sellers, and that's why it reversed up, and it closed back above the 300. That is the main signal. That's the primary signal of why I took the trade. However, I always like to have confluences of signals, even if they are supporting signals, and the supporting signal on this particular trade was at the same time with the primary signal, with the intraday rejection of the 300-day moving average. We also had a V1. A V1 consists of two bars, bar 1, bar 2. Bar 2 goes under bar 1's low and closes back above bar 1's close. And this happened. So I had a primary signal, intraday rejection of the 300-day moving average, which is a deep dip buy, and we also had a V1. So that was the reason for my entry. Now, when I decide to take a trade, of course, we always have to decide how many shares we are going to buy. And I have a very simple formula that has worked very well for me, and it consists of two things. The first, it consists of what is the value of my trading account, and number two, what is the value of the 2 ATR, the average true range times 2, the 2 ATR. You can see right here, right now, it's $8.57. So I take, first thing I do is I take 1% of my trading capital. 1% of my trading capital, let's say we had a $100,000 trading account. 1% of $100,000 is $1,000. $1,000 divided by the value of the 2 ATR is divided by 857. The value is 116.68. So I took 1% of my trading capital, which is $100,000, 1%, divided by the value of the 2 ATR. It tells me to buy 116.68 shares. I would just round that up to 117. That is the correct amount of shares for the way that I trade, based upon the value of my trading account and based upon the 2 ATR. And what is this telling us? This is the volatility. If the volatility is higher, this number is going to be larger, and therefore we're going to buy fewer shares. So when volatility is higher, just by default, this formula will have you buy fewer amount of shares. If the volatility is lower, this number will be lower, and therefore you will buy higher shares. It's the correct way to trade, in my opinion. So I'm buying 117 shares here at $285.61. Now, first thing I do is I take my entry price minus the value of the 2 ATR and I place my emergency stop. This is the red line all the way down here. Now, if I have 117 shares and it moves down to my emergency stop, how much have I lost? Well, I've lost that $1,000 that we began the formula with, right? That's 1% of my account. So I am risking potentially 1% of my account on this particular trade. Now, the good news is that will only happen about 5% of the time. The other 95% of the time, if I have a loss, it will be because of my end of bar stop. So I always place two stops. So the first stop is 2 ATRs underneath my entry. If it does come here, I'm going to lose 1% of my account. The other, but again, only 5% of the time, in my experience, that happens. The other 95% of the time, if I have a losing trade, it will be because of my end of bar stop. Well, my end of bar stop on this particular trade is the 300-day moving average. Generally, it's the reverse of why you got in. If I got in because it rejected the 300-day moving average and then it closes back below, I'll simply get out for a loss, but a much smaller loss than my maximum allowed loss, which is the emergency stop. Make sense? Okay, so I have got my signal, rejection of the primary signal, 300 rejection of the 300-day moving average. My supporting signal, which is the V1, I got long, $285.61. I position size, like I just showed you. I place the emergency stop 2 ATRs below. My end of bar stop is a close below the 300-day moving average. The next thing I do is I take my entry price plus the value of the 1.5 ATR. Right now, the value of the 1.5 ATR is $6.42. So I take my entry price, add 642. This is the orange line. What is this line? This is my trailing stop level. If I get to trailing stop level, now I go into trailing stop mode, which means in the future, if I have a close below a previous bar's low, I will exit half. It's just a way, if you've moved up 1.5 ATRs from your entry, okay, now you have a good trade, and I'm tightening up the stop. I'm tightening everything up by selling half of my remaining shares if we get a close below a previous bar's low after reaching trailing stop level, like you can see that we did here. So now, emergency stop, end of bar stop, trailing stop level, these are all defensive moves. I am going to take action, do something if it goes against me defensively. But I like to also play offense in my trading, and the way I play offense in my trading is I take partial profits each day if the market gives them to me. And the way that I do this, I use the 0.45 ATR. Right now, the 0.45 ATR value is $1.93. So this, I'm in this trade right now. I'll show you exactly what I'm doing for Monday, and I do this every day. I have to reconfigure it every day. I take the closing price. Right now, the closing price is $302.89. I take the closing price plus the value of the 0.45 ATR, which is $1.93. And so my first profit target for Monday is $304.82. If it does get there, however many shares I'm going into the day with, I will take 10% off at that first profit target. So I have 500 shares, for example, I will take 10 off at that first profit target. Now, I always set 3 profit targets. So I showed you how to do the first one. Closing price plus the value of the 1.5 or 0.45 ATRs. Adding those two together is 304.82. I do it one more time. I take the first profit target plus, again, 1.93. That is my second profit target. And then to get the third, I take the second, again, plus the 1.93, and that is my third. And I always place 3 profit targets per day. If it goes up and it's a decent day, maybe I'll hit 1. If it's a really good day, I'll hit 2 profit targets. If it's a great day, I can hit 3 or more, right? But I like to take partial profits into strength. And there's so many examples of why that is an important thing to do, because the advantages are, one, you take a portion off, you lock it in. It also reduces your position size, which helps a lot of people, because as it goes up and goes up and goes up, you're reducing your position size and you're reducing the emotional stress of being in that trade. And that all comes down to following your position. Just bottom line, the fewer and fewer shares you have, the more likely you are to follow your process. So there's a lot of advantages to it. And it makes sense to play offense and defense, just like in sports. Okay, so now that we've kind of got that out of the way, let's take a fresh look at it. And here we go. Intraday rejection of the 300-day moving average plus a V1. I enter 285.61. Position size, like I showed you, place my emergency stop 2 ATRs below. My end of bar stop is a close below the 300-day moving average. I place my 1.5 ATR trailing stop level above, and the next day moves up strongly right out of the gate, which is great. I hit 2 profit targets. So I take those, lock those in, reduce my position size. Market can't take it away from me. Next day it goes up, not enough for a profit target, but it gets me to trailing stop level. Now I'm in trailing stop mode, which means if I have a close below previous bar's low, I will get out of half. Next bar up again strongly, hit multiple profit targets, which is great. The next 3 days doesn't really do much. Here on the 8th, we have our first close below a previous bar's low after reaching trailing stop level. I took off half of whatever shares I had left. Now it's fewer shares than I started with, right? Because I took profits on the way up. So let's just say I started with 100. Maybe I have 70, right? When I get to here, well, I take half of 70 off 35. Those aren't exactly numbers, but just easy numbers for me to explain to you. So, but again, we got to trailing stop level. We have a close below a previous bar's low. I take off half of the remaining shares I had going into the day, and that's it. I lock in a gain of 2.12%. Then we have another nice 3 days up here where, again, I have half the position, but I'm taking off partial profits as they're hitting their 0.45 ATR profit target levels. And then we really just kind of move sideways here. We had some profit targets here. We had some profit targets here. I did hit one profit target on Friday as well. So I'm continually reducing my position size, and the remaining shares that I have on this particular trade at the moment, up 5.67%. But look at my risk to reward ratio over here at the 300. Remember, if it had just closed below the 300 the very next day, I would simply have been out, even if it closed under a penny. So it all comes down to risk to reward, right? We're always going to have a lot of losing trades, and that's fine as long as you keep those trades small. But you have to have the ability to have a big outsized win compared to what you're risking. And this is a perfect example of this. Very good risk to reward ratio. Was fortunate enough to have this trade. The remaining shares of 5.67%. Earnings are coming up here. Looks like on the 6th of August, I will exit before earnings. I never hold through earnings. So McDonald's, nice trade. Remaining shares up 5.67%. Okay, BITO. All right, so BITO. So what I just showed you on McDonald's was deep dip buy, right? Well, I use 7 different strategies. This is a different strategy. This is what is called a bearish abandoned baby. And the bearish abandoned baby happened here on the 14th of July. You can see this bar that I highlighted with the red background. Why did I short Bitcoin? Okay. The previous day we gapped up, so there was a lot of bullish sentiment in the market. We gapped up. Well, after that gap up, the very next day we gapped down. So there was a big change. Everybody went from bullish to bearish very quickly. And when that happens, in my experience, when you look out into the future, you are going to see prices lower. So I shorted here on the 17th of July. Why did I short here? Well, when you have this abandoned baby, again, a gap up followed by a gap down. The bottom of the baby, the bottom of this middle bar here is a key resistance level. On the day that I shorted, we went above the bottom of the baby, but then by the end of the day, we closed below it. Or in other words, we rejected the bottom of the baby. Now, on almost all of my other strategies, I take partial profits. I go into trailing stop mode. Everything I just showed you on McDonald's. But on this particular strategy, I make it easier on myself because this is such a strong strategy that what I do is I place a 2 ATR stop if I am wrong, and I place a 4 ATR profit target if I am right. So if I'm right, I'm going to make twice as much money as if I'm wrong. So if I place a 2 ATR emergency stop, how much am I going to lose of my total account if I hit that? 1%, right? If I hit my 4 ATR profit target, how much am I going to make? I'm going to make 2%, right? And that's fine. So when I have a setup that shows me statistically more times than not it's going to be right, that means more times than not I'm going to make twice as much as I'm going to lose. Okay, that is a good proposition, right? Odds on your money. So I got short here 22.87. I placed my 2 ATR stop above. I placed my 4 ATR profit target below, and on Friday I hit the 4 ATR profit target, right? Really nice. So this particular trade on this bearish abandoned baby up 11.67%. I locked that in. I am now out of the short. And by the way, if you'd like to learn more about abandoned babies, there's both bullish abandoned babies, bearish abandoned babies. Go to my YouTube channel. I have a free video there that explains what abandoned babies are and also what island reversals are. They're similar to abandoned babies. It's just that abandoned baby you use 1 bar, island reversals you use 2 or more bars. But this is a really great trade. 1, 2, 3, 4, 5, 6. In it a little over 2 weeks, but yeah, played out just perfectly. Abandoned baby, rejection of the bottom of the abandoned baby, 2 ATR stop, 4 ATR profit target, and Friday with this big move down, locked in out of the trade, locked in 11.67%. Okay, UNG. Okay, so UNG, I did get long UNG on the 31st of July here at $13.58. Why did I get long? Well, here I have a green box here. What is this? This is an order block. And order blocks are one of my absolute favorite areas to buy. And I'm scrunching this chart up. I apologize because I know you can't see much, but an order block is the lowest bar close before you have a market structure change. And these order blocks have memories. Well, there's an order block. I know you can't see it because it's so scrunched, but this is back here on the 4th of December, 2024. The high and the low of that lowest bar close, if I draw this out into the future, that is what I like to call a smart money area. And if I get a rejection of the high of the order block or the low of the order block or some type of moving average or RSI reading inside the order block, that is my signal. Well, you can see on Thursday when I took the trade, we did reject the high of the order block, right? The high of this box. In addition to, so that's the primary entry signal, was a rejection of the high of the order block. But there are also some supporting signals as well. We have a V1. Here's bar 1. Here's bar 2. Bar 2 goes below bar 1's low, closes above bar 1's close, adds bonus points to the trade. And we also rejected the negative third ATR channel. 92% of prices when they get to the negative third ATR channel tend to stop going down or stop going down or go up. And so therefore, that is the signal. Primary rejection of the bullish order block. Supporting V1 plus a rejection of the negative third. You can see we closed back above the negative third. So I entered at 11.58. I place my emergency stop, of course, 2 ATRs below. My end of bar stop on this one is just going to be a close below the low of the order block. If it closes underneath, I'll simply be out. I place my 1.5 ATR trailing stop level above, and away we go, right? I was patient. I waited for the signal. I took the signal. I certainly cannot control anything about UNG, but the important thing is I know exactly what I am going to do regardless of what UNG does. That's the only power I have in this particular setup. I position size correctly, and I know what are the worst case scenario. It goes to my negative, it goes to my emergency stop. I lose 1% of my account. If it goes down and closes underneath the bottom of the order block, I lose money, but I don't quite lose 1% because it's not here. If it moves up, I'm going to take partial profits. If it gets to trailing stop level, I will go into trailing stop mode, right? So I know exactly what I am going to do. If eventually this really runs and we get to a 65 RSI level, then I have a different rule. I'll use the 5 EMA as the trailing stop. If we reject the 70 RSI, I'm going to get out of half. If after rejecting the 70 RSI, I have a close below previous bar's low, I will get out of everything, right? So you have to know exactly what you're going to do in all moments. If you're just like, oh, I wonder what I'm going to do today, just however I feel, you're going to have a problem with trading. You have to have your plan going into the trade, and then more importantly, you have to follow it. So this trade space, it's up a little bit. It's basically just break even though, and so we'll see what happens. Okay, VIX. All right. So I did enter VIX on the 29th of July. Why? Well, this is kind of an interesting trade because you can see here's an order block, okay? This is an order block, but this order block is not from the daily. It is from the weekly. And again, these order blocks hold memory. Well, here's your order block all the way back from 124.25, long time ago. Lowest bar close before market structure change, the high and the low of that order block into the future defines the green box. Again, this is a weekly. However, I did end up taking the trade on the daily. Why? Well, for a couple reasons. One, it rejected the bottom of the order block on the weekly, which is fine. Sorry, give me one sec. Somebody's at my door. Okay, sorry about that. Someone knocking at my door. So, where was I? Okay, so VIX. Again, this green order block is based upon the weekly, which is fine because, but on the daily, we also had some good price action. We had another V1, bar 1, bar 2. Bar 2 goes under bar 1's low, closes above bar 1's close. And again, we close back over the negative third ATR channel. So primary signal, rejection of the bottom of the weekly order block, although it happened on the daily. Supporting signal, V1 plus a close back above the negative third ATR channel. You could also make the case another supporting signal would be a MACD divergence. Here we have the lows. These lows, you can see how deep these red MACD bars are. Now here we're lower. These bars here, even the deepest one, is not as deep as the prior. So we have a bullish MACD divergence. So a lot of different signals that came together in order for me to take this trade. So I took this trade at $42 even. I placed my emergency stop 2 ATRs below. I placed my end of bar stop just a close below the low of the order block. Placed my 1.5 ATR trailing stop level. And the next day moves up a little bit, enough for me to have a profit target. Then it gaps back down, actually goes under the bottom of the order block, but I wait until the close. It basically ended up even on the day. And then Friday, of course, it exploded up 8.13%, where I hit multiple profit targets. And, now it's off to an interesting an interesting move. And I'm going to talk a little bit about the markets and the indexes in the coming up this week, what's changed. But even from the VIX standpoint, we have now changed market structure on the VIX from bearish, clearly bearish, to bullish. Why? Here's a swing low, here's a swing high, here's a lower swing low, and now we have taken out that first swing high, which means we have now changed market structure on volatility via VXX to bullish. Now, I wonder if I should show you this now or, well, I'll show you after. But as far as this particular trade is concerned, the remaining shares that I have on VIX on this particular trade up 8.54%. You know what? I guess I'll get into it a little bit right here, and you've heard me talk about this on previous podcast, and I was talking about this level on the VIX for quite a long time, and you can see if you go back into the future on VIX doesn't tend to go much lower than where it's at. Okay, and so VIX is usually the inverse of the market, and so what I was saying and what I have been saying for weeks is if VIX gets down into this green order block, that's very likely going to mark a top for the markets. That's exactly what happened. It's exactly what happened. That's why I've been telling people, please be careful with the indexes. Yes, they're up, they're going very well, but when you look at these other signals like VIX, you're getting down into an area where VIX is very likely to bounce, and therefore, if VIX bounces, the indexes will probably go down. And again, that's what happened. So the VIX trade using the weekly order block and the supporting V1 rejection of the negative third ATR channel, bullish MACD divergence, that worked out really well. So remaining shares up 8.54%. Okay, so those are the open trades. Let's get to the closed trades. So the closed trades, MasterCard. I got long MasterCard. Really good example of a purely deep dip buy signal. Got long MasterCard 620.25. Really good setup. Two strong signals. First signal, intraday rejection of the 200-day moving average, right? Classic. That's legitimate at any time. But also on this particular day, in addition to having an intraday rejection of the 200-day moving average, we also had an intraday rejection of the 30 RSI on the same day, right? Confluence of signals. I always need some kind of confluence of signals. These are two primary signals, not a primary and a supporting. These are two primary signals, right? So I got long 532.95. I placed my emergency stop 2 ATRs below. My end of bar stop is a close below the 200-day moving average. I placed my 1.5 ATR trailing stop level 1.5 ATRs above my entry. The next day it moves up nicely, hit some profit targets. Next day up again, hit multiple profit targets, and I get to trailing stop level. Because I'm in trailing stop level, if we have a close below a previous bar's low, I'll get out of half. That happened here. This is the first time we have a close below a previous bar's low after reaching trailing stop level. I locked in gain on half of the remaining shares of 3.07%. And then we have this nice move up here where I took partial profits along the way, and then we move sideways, and then we move down, and then we move sideways, and then somewhere in here had a couple of profit targets. And then here I exited the trade on the 30th of July. Why? Well, because at the end of the day, or that next morning, I can't remember, we're going to have earnings. So I never hold through earnings. So I don't like to gamble on earnings. I just get out wherever it is, gain, loss, or whatever. And I got out here for a gain on the remaining shares for a gain of 4.68%. And then earnings were really good and it went blasting off. I was like, dang, but that's fine, right? But now it came back down. It's just about the same place. So I am completely now out of MasterCard. It's been a really nice trade. The remaining shares there I had gain of 4.68%. Okay, Love. Love is a trade that I took on Thursday and I am out on Friday. Now, it was a losing trade. That's a bummer. But what this shows you here is good traders, professional traders. If you look at their trades, you are going to see their losing trades. If you look at how many days they're in, you're probably going to see they're in for 1 day and then out, or 2 days and out, or 4 days and out. You're going to see a short amount of days. I have tons of trades, losing trades, where I'm in 1 day, I'm out the next day, and I'm just out. But if you look at my winning trades, maybe I am in them for 18 days. Maybe I'm in them for a month. That's the key. It's okay to have losing trades. You're going to have them all the time. But if you were to do a deep dive on the analytics of your trading, you will see good traders, they are in their winning positions 4 times, 5 times, 6 times, 10 times longer than they are in their losing positions. So, did I have a good signal? I did. Here we have an order block. Here we have a rejection of the 250-day moving average inside the order block. Perfect signal. Really, perfect signal. I took the signal. I got in at $30.71. I placed my emergency stop 2 ATRs below. My end of bar stop was simply a close below the low of the order block. And Friday, what did it do? It closed below the low of the order block, so I had to get out. Now, am I sad about this trade? No, I am not. I am just happy that I followed my rules. The longer you're in trading, the more this should resonate with you, because you know over time, following your rules is the only thing that matters. Any one particular trade in the middle is nonsense. It's nonsense. It's noise. It doesn't matter. Why are we clutching our pearls over one trade? Right? We're going to have thousands of trades. So just pat yourself on the back that you followed your rules and you got out, even if it was a loss. Really, I cannot, strongly enough try to make this point. One trade is just one trade. It doesn't matter whether it was a win, whether it was a loss. Over time, you're going to see that your losing trades are you're going to be in a very few amount of days, and your winning trades, a lot of days. So, just not time for Southwest Airlines, right? Just not time. Now, going forward, can I get back in? Yeah, sure. Maybe if it gets back above the 250, back in the values or back in the order block, the reason I took it in the first place, sure. But it just didn't work. Loss of 3.12%, and only in the trade 1 day, which I'm proud of, really. Strange thing to be proud of, but it is true. All right, INDA. INDA was a bullish abandoned baby. Now, I showed you on Bitcoin where I hit the 4 ATR profit target. This one didn't work. Here's the abandoned baby. We have a gap down, followed by a gap up. I placed my 2 ATR stop below. I placed my 4 ATR profit target above. The very next day, it hits my 2 ATR stop. Bummer? Sure, bummer. But on this, I lose 1%. On the Bitcoin, I make 2%. Do you see the difference? And I would take this trade over and over and over. This one didn't work. But about 70% of the time, in my experience, they do work, higher than 70% of the time. So, but this one just didn't work. So, had a loss of 1.42%. Netflix. All right, Netflix, again, another trade that didn't work, but I was out quickly, right? I took the trade here on the 25th of July. Why? Because we rejected the bottom of the order block. I got long, 1180.33. I placed my emergency stop. 2 ATRs below my end of bar stop. Where? A close below the low of the order block. The very next day, it closes below the order block. I am out of the trade. I lose about 0.43%. And again, I am proud of that. I love when I enter a trade and the next day I'm out, because it means I'm trading the correct way. Now, If I would have said, okay, I'm tired of this. I don't think it's going much lower. Well, oh, okay, great, and then down, and then down. This could just continue to go down. Now I don't care about it. So a loss of 0.34%. So these are the dailies. And I just kind of want to reiterate here. You're going to have winning trades, you're going to have losing trades. But if you're trading correctly, doing the right thing, over time, you are going to see much higher returns on your winning trades than your losing trades. Let's go through and take a look. We'll just do a little bit of a review. McDonald's, out of the remaining shares for a gain of 5.67%. Bitcoin, out of the Bitcoin trade on the bearish abandoned baby for a gain of 11.67%. UNG, just roughly even at this point. VIX, up 8.54%. Okay? Basically all winning trades here. MasterCard, gain 4.68%. Southwest Airlines, loss 3.12%. INDA, loss 1.42%. Netflix, loss 0.43%. But what I just showed you there was a mix of wins and losses, but clearly the wins were much larger, even double-digit wins, and that's about what trading, or that's what trading is about, right there. Keeping your losses small and then occasionally having those big wins. That's how you make money long-term in trading. So those are all the daily trades. Let's quickly look at the weekly trades, then we'll get on to some other things here. This is UUP. This is the dollar. This is a really nice setup. I entered the dollar here on the 11th of July at $27.21. Why? Just a bunch of combinations. Rejection. Well, first of all, we had a close under and a close over the 200-day moving average, which is the black line. So close under, close over. Boom. Okay, that's a primary signal. We also rejected the high of the order block. The previous week we were below it. Now we close back above it. That's a rejection of the higher of the order block. So we have two primary signals. Did we have some accompanying signals or supporting signals? Yes, we did. We had a V2. Bar 1, bar 2, bar 3. 2 goes below bar 1's low. 3 closes above bar 1's close. There you go. So it's a nice combination. Two primaries, one supporting. I got long here. 27.21. I placed my emergency stop, of course, 2 ATRs below. On this particular trade, what is my end of bar stop? Close below the 200. That's it. Place my 1.5 ATR trailing stop level above. Next week went up for a profit target. Next week went down. No profit targets. This week up nicely. Really, really nicely, where I hit multiple profit targets, and I also got to trailing stop level. You can see, got up to the orange line, came off of it on Friday, but I am now in trailing stop mode, which just means now if I have a close below previous bar's low, I am going to get out of half. Okay, so this particular weekly trade doing fine, up 1.27%. TLT, I have been in this trade so long, I think I've been in it at least 150 years. I have been in this trade from 117.25, basically since January. Why? Okay, here we have the green box. This is an order block. We rejected the high of the order block. I got long 87.20. In addition to that, the supporting signals were we had a close under, close over the negative third ATR channel, and we had a V1, bar 1, bar 2 goes under bar 1's low, closes above. So I have primary and supported signals. Got long, 87.20. Placed my emergency stop, 2 ATRs below. My end of bar stop, a close below the low of the order block. I placed my trailing stop level, 1.5 ATRs above. Okay, we kind of drip up here. I get a profit target, a couple of weeks of nothing. And then here, nice multiple profit target and got to trailing stop level, which is great. Okay, we move sideways, I get a profit target here, I get multiple profit targets here, which is great. I'm in trailing stop mode. And then the world fell apart here. We have a close below the previous bar's low. I had to get out of half of the remaining shares that I had for a loss of point, I can't read that, 0.53%, I think, which is fine, right? It's a small loss. I have to follow the rules. But again, I took partial profits on the way up. See how important that is? Okay. So I got out of half the position here. And basically, since that time, we went up. I hit profit targets, and then we went down. I didn't do anything, but it never closed below the low of my order block, so I stay in the position. And then we kind of move ourselves up here for about a month where I did hit one profit target, and then we came back down. But over the last 2 weeks, we have moved up, and I did hit a profit target here. And glad to say the remaining shares on this position finally went positive, up 0.73% on the trade. But, the good thing about TLT and being in this trade is I have had 8 months of dividends from being in this trade. So not only am I positive now on the trade, I've also had the dividends from the trade. So this particular trade, been in it forever, up 0.73%. All right. Last but not least is Shopify. I shorted Shopify back here on the 18th of July. Why? Well, normally you see the green box. Now we have a red box. A red box is a bearish order block. It is the opposite of a bullish order block. Here we have a high. Here we have a swing high. Here we have a swing low. Here we have a higher swing high. Here we break structure to the downside. When that happens, the highest up bar close, the high and the low of the highest up bar close before market structure change. This is now the bearish order block. This goes out into the future. This is more than likely, if it fails, this is where it's going to fail. So I got short here on the 18th of July. Why? Well, because it poked its head above the high of the order block back on 214, but it rejected it. It went above and closed back below. That is a rejection. That is, for me, a short signal. So I got short 127.03. Because I'm short, I placed my 2 ATR emergency stop, 2 ATRs above. My end of bar stop is simply a close above the high of the order block here. The high of the order block is 128.57. That's this red line here. If it closes above there, I'm simply out of the trade. Now, if it goes my way, I place my 1.5 ATR trailing stop level below, which I did. And let me take a look. I'm trying to find here. Yeah, okay. So I placed my 1.5 trailing stop level below. If it gets here, I go into trailing stop mode. So it was down this week. I did hit a profit target to the downside. So I hit one profit target. I locked that in. I covered 10% of the shares that I had remaining. And earnings are coming up here on the 6th. I will get out of Shopify before the earnings. But so far, this particular short trade doing quite well, up 7.21%. So those are all the positions. I know it took a long time to get through these, but I think it's good because there are all sorts of different strategies and setups in there, right? What we looked at bearish order, or we looked at bearish order blocks. We looked at bullish order blocks. We looked at deep dip buys. We looked at bearish abandoned babies, bullish abandoned babies. So shows a lot of the different strategies, not just focusing on one particular strategy, but using a variety of them and using them and doing well with them. And by the way, if you would like to learn these, I do my best here on this podcast to explain, but there's a lot of nuances to them. I do teach private one-on-one lessons. I teach a 20-hour course. I teach people from all over the world. I teach them step by step all the rules and how to identify these. If you take my course, I promise you, you're going to be a better trader. I love to teach and I love to see my students succeed. And so if you would really like to learn the skill of trading, I have traded for over 30 years. I have taught hundreds of people around the world, and I would love to have you as a student. So if you're interested, just send me an email and we can set up a call and I will teach you everything I know. And I know you're going to be happy that you took the course, and my email is in the link in the description. So, okay, those are all the trades. Before we get on to the trades for next week, let's spend a moment and talk about trader psychology. This is from Stephen Goldstein. Stephen Goldstein is a famous, world famous trading coach, retired trader. He has this great podcast. It's called Alpha Mind 101. They interview professional traders, retail traders, hedge fund traders, everywhere in between. I was fortunate enough to be a guest on this podcast twice, where Stephen and his partner interviewed me about my trading and so forth. So I would really recommend that you listen to his podcast, and you can follow him on Twitter at AlphaMind101. So let's see what Steve says. That surge of awesomeness when you feel when the market moves your way is great, but is also dangerous to your success as the despair you feel when you're losing. So say that one more time. The surge of awesomeness you feel when the market moves your way is great, right? It is great when the market moves your way. You love that feeling, but it is just as dangerous to your success as that despair when things are going against you. So when things are going great, you know that great feeling. When things are not going your way, that despair, you know that horrible feeling. These are the two areas that you need to be careful in. Of course, when things are going down, you can make bad decisions, you feel horrible. That's a dangerous area. But when things are going up, it makes you feel bulletproof. That is just as dangerous, is what Steve is saying. So it makes you feel invincible and diverts you from optimal behavior. Whether you're super high or super low, those are the two areas that can divert you from optimal behavior, because you either feel invincible or you feel complete lack of confidence and despair, and it's hard to make a decision. Those are your two vulnerable areas. That's why you write plans in a cold state. What's a cold state? A cold state is when the market is closed, uh, you don't see flashing red and green. It is the best time to make a trading plan. I can't say 100% of the time, but the majority of trading plans created when the market is closed, just to make it simple, are decent trading plans. Okay, I'm going to risk 2 to make 4. Great. Good trading plan, right? But what the worst time to make decisions is in the middle of the day when you're feeling bulletproof or you're feeling very frustrated. If I could sum up trading right, I try to do it right here. Get yourself a trading process that you create when the market is closed, and then come hell or high water, whatever it takes, follow the process. Don't get distracted in the middle of the trade. Oh, I read this. I saw this on the news. Well, maybe I feel this way. Just create the freaking plan and just follow it. They're not all going to win, clearly, but some of them are going to win. And if you've created a good risk to reward ratio for yourself, you're going to win more on your winners than you're going to lose on your losers. It's really simple. Trading is super simple, and people just make it really complicated. But Steve is right. The two areas where you really, really are dangerous areas where you divert yourself from optimal behavior is when you're super high winning or super low losing. Wait for the market to close, get your wits about you, create a plan, and follow that. So thank you, Stephen Goldstein. Hope you're doing well, and please follow Stephen at AlphaMind101. All right, listen, let's get to the potential trades for next week. And as we go through here, I'm going to show you some changes in the structure in the actual market, because we've had a big change, everybody. We have had a big change Thursday and Friday. Okay, so on the dailies, I have 10 potential setups for next week. Now, I mention this every week. Theoretically, Monday, all 10 of these could trigger. Would I take all 10? Would I take all 10 trades? No. I only take one trade per time frame per day. So if all 10 of these were to trigger, I would have to narrow it down to the best signal. How would I do that? Well, I give it points, like a report card, and then the one that has the highest point total, that's the best one. How many signals did it? How many primary signals did it have? How many secondary signals did it have? What's the risk to reward ratio? What does it look like on a higher time frame? Relative strength. What's the relative strength of that particular stock compared to the market in general? These are all things that I come up with and I factor in. And this is what, again, if you become my student in the 20-hour course, this is what I will teach you, how to do this. It's very important. My trades, you're always hearing me talk about primary and secondary. Well, if something has two primary trades and two secondary trades and it has a good risk to reward ratio and it has good relative strength, I'm probably going to take the dang trade, right? All right, so I just wanted to make that clear. So here's Apple. Now, Apple had earnings on Thursday evening. Now, if I would have told you, hey, I've got some inside information, Apple is going to have its highest revenue that it's had in a couple years, what would you do if you had that inside information? Well, the easy answer is you would buy it, right? Has the highest revenue right off the bat, you would think it would go up. It got hammered on Friday. So what's my point? My point is you never know what is going to happen with earnings. Even if you had inside information, it still may not do you any good. You can have horrible earnings, the stock goes up. You can have great earnings, the stock goes down. That is why I, at least for myself, and what I suggest to my students is do not hold through earnings because you just never know what is going to happen. And this is a perfect example. Okay, so here's Apple. Got clobbered. Is there an opportunity for us? I think so. Look, we have a nice order block over here on the 17th of June. Lowest bar close before market structure change. The high of the order block is 198.39. The low of the order block is 195.21. Now, there are no moving averages in the middle. However, I can just tell, looking at the RSI is 35.46. Well, from a deep dip buy perspective, an under 30 over 30 is a legitimate deep dip buy signal. If Apple continues down into the bullish order block, then almost certainly we will be near 30 RSI or below. So if Apple goes under 30 over 30, at the same time it's in the order block, I would take the signal. So I'm looking either for rejection of the high of the order block, a rejection of the low of the order block. The high is what, about 198.44. The low is about 195.06. So I'll just have to see how it goes, right? I mean, it's going to look different on every single day. But in big picture, rejection of the high of the order block at 198.39, rejection low of the block, low of the order block 195.31, and ideally an under 30 over 30 inside of the bullish order block. Again, under 30 over 30 is a deep dip buy. Oh, and I forgot to mention, by the way, speaking of deep dip buys, of course, I teach that in my trading course, in my one-on-one trading course. But you can, if you want to learn about just deep dip buys, I have a great video course, a 9.5-hour video course at udemy.com. It's very affordable. It takes you step by step through trading the deep dip buy signal. Doesn't include order block. It's just deep dip buy, but it's great course. I've sold so many of those around the world. It has like a 4.85 stars out of 5. It's great. And it's super affordable. And it's a great place to get started. And the Udemy link's in the description. So I forgot to mention that when I was talking about the course. So anyway, so that's what I'm looking for on Apple. rejection of the high of the order block, rejection of the low of the order block, and ideally a rejection of the 30 RSI inside the order block. And I think it's very likely. We're already at 35.46. Probably if it gets to the high of the order block, depending how long it takes to get there, rejects the high of the order block, it'll probably also reject the 30 RSI. And that would be my spot. That's what I'm looking for on Apple. Amazon. All right. Well, you can see the red box above was the bearish order block where it should fail. That is where it did fail. But we have a good opportunity here on Amazon on this order block. You can see this order block. This order block started on the 23rd of June. The high of the order block is 210.39. The low of the order block is 207.31. Again, this is the lowest bar close after market structures change. Look, here's a swing low, here's a swing high, here's a lower swing low. We break market structure to the upside. When you break market structure to the upside, the lowest bar close before market structure break is your order block. Now, I always like to, with my students and when I'm teaching, here was the order block. If you look here 10 days ago or whatever, in hindsight, if you look back to this order block, was smart money buying at this area? Clearly they were, right? If you look here at the high and you look back, clearly smart money was buying there. So I kind of like to call these smart money areas as well. Now, smart money was buying here because in the future we went up. Well, now we're coming right back down to the same area that the smart money was buying. Is it smart, but it was smart money then? Is it smart money now? Maybe, maybe not. Maybe things have changed. But in my experience, if it was once smart money, more than likely it will be smart money again. Don't know for sure. Have to have my stops, have to have my levels. But that's what I'm looking for. And look, we have a 200-day moving average, which by itself, that deep dip buy is a legitimate entry by itself, but it's living inside of this order block. So ideally, a rejection of the 200-day moving average inside the order block would get me long there. A rejection of the high of the order block, which is also very close at 210.39, could get me long. Or a rejection of the low of the order block at 207.31. So that's what I'm looking for. And, who knows if these levels will hold. But if they don't hold, I'm out quick. If they do hold, I have potential for a nice trade up. But that's what I'm looking for. Rejection of the high of the order block, the low of the order block, or rejection of the 200-day moving average that's now living inside the order block. Oh, sorry. I did not want to have Berkshire Hathaway. I have it on the weekly. Here is DIA, which is the Dow Jones Industrial. Well, you can see the red bearish order block that I drew above. It worked. When it got into that red area, that was it, right? It's amazing how these order blocks work. Well, how do we use these order blocks in the future? Well, you see the green order block below. Here is your lowest bar close back on the 20th of June, the lowest bar close before market structure changed, the high and the low. The high is 424.15, the low is 420.72. This was the smart money area, clearly. When you go to the highs, yeah, that was smart money. Will it be smart money again? I don't know, but it is more likely. So what I really like is this 100-day moving average that's inside of the order block. Now, we're quite a long ways away from this. I don't know if we're going to get there, but the three levels would be the high of the order block, a rejection of the high of the order block, 424.38, potentially rejection of the 100-day moving average inside of the order block, that is at 422.35, or of course the low of the order block, and it's hard to see, but there's a 300-day moving average at the low of this order block, and the low of the order, let's see, the 300-day moving average is 420.42, and that dovetails with the low of the order block. So rejection of the high of the order block, rejection of the 100-day moving average inside the order block, or a combination rejection of the low of the order block and the 300-day moving averages, where I would potentially consider getting long DIA. Intel almost took this trade on Friday. I was chatting with Steve, one of my students, and we were kind of stalking and following this trade the entire day. But at the end of the day, it didn't quite get there. You can see we have this order block, and long-term, this long-term order block on Intel has held for many, many, many months. Will it hold this time? I don't know. But what I was looking for was a combination of a rejection of the bottom of the order block, which it didn't quite do. Looks like the low of the order block was 1934. But I was watching at the end of the day, the RSI. The RSI is 2981. Had this closed above 30 RSI, it would also close above the low of the order block, which would have been a really nice confluence. Two primary signals, rejection of the bottom of the order block and rejection of the 30 RSI. Did not come. I did not take the trade. However, if on Monday it closes back above 30, then just logically it will close back above the bottom of the order block, and that is where I will enter. So basically next week, I'm just looking for Intel to close above 30 RSI. But it depends, if it goes racing up huge, obviously it's going to close over 30. It doesn't mean I'm going to take it at any level, because then the risk to reward wouldn't be very good. I need this to just kind of gently close above 30 RSI, maybe stay at 31, 32, 33, 34, something like that, right? So nothing's black and white. You have to put it in context. But I'm not going to chase this if it closes at 40 RSI, right? So I'm looking for a nice gentle close back in the order block and a nice gentle close above 30 RSI to give me a good risk to reward everywhere. But I'll be watching this one closely. Coca-Cola. All right, so Coca-Cola, we have an order block, and I've been talking about this for weeks. We just haven't got there. Maybe next week we get there. Here's a nice, big, wide order block. Not interested in rejection of the high of the order block. The risk to reward's not very good. But three levels here that I'm looking for on Coca-Cola next week. Here's the 250-day moving average, the purple line. Here's the black line, the 200-day moving average. Here is the orange line, the 300-day moving average. All three of these are fair game, especially by themselves, deep dip buy-wise, they're fair game. But being that they live inside the order block, even better. So I'm looking for a rejection of the 200, 250, 300. Be nice on top of that if we had a V1 or a V2, something like that. But that's what I'm looking for to potentially get long Coca-Cola. Netflix. Man, everybody wanted Netflix. Nobody wants Netflix. And I showed you, I did take this trade. Was a losing trade. I was in it for one day and out the next day. But now that we have lost this order block, I need to go to the lower order block. Well, the lower order block is very, very interesting because we have the 100-day moving average inside of the order block. The 100-day moving average is at 1125.44. It lives inside that lower order block. Right now we're to 3664 RSI. So if next week we do go down and we reject that 100-day moving average that's at 1125.44, very likely we will have a rejection of the 30 RSI, and then we will have lots of primary signals. Rejection of a 30 RSI, rejection of 100-day moving average, all inside the order block. So I'm going to be watching this very closely, but just to make it simple, really I'm looking for a rejection of either the high of the order block, rejection of the 100-day moving average, or a rejection of the order block in the 30 RSI. It's hard for me to say because it depends how many days it takes and what the readings are. But essentially, something in this area is what I'm looking for that I just highlighted in blue. Qs. All right, everybody. So listen, we had a huge day down on the Qs the last 2 days. We took out, I think, over 20 days of up moves in 2 days. That's how it works. Now, what could have keyed us off to the fact that this may have been coming? Okay, first of all, from a MACD divergence standpoint, look, we are high. We are going higher and higher and higher and higher and higher. But look, we have green MACD bars here, and then no green MACD bars whatsoever, even though we are going higher and higher and higher. That is not healthy. That is a red flag. It's showing that we're going up. Even though we're going up, the momentum from MACD is not supporting that. All right. So what happened on Friday? We changed market structure to the downside. Why? Because we have a swing high, and then we have a swing low, and then we have a higher swing high, and Friday took out the first swing low. We are now changed into a bearish market structure on the Qs. That's it. So as far as the Qs go here, what am I looking at? Two different potentials. If we go lower, we have a bullish order block down here. The high of the order block is 533.56. The low is 524.88. That's quite a long ways away. A rejection of the higher the order block, sure, I would consider taking it. A rejection of the lower the order block, I would consider taking it and getting long. But we also have a bearish order block above us. Now, after we've had this big down move, maybe it continues one more day or two. Who knows? But I would not be surprised if we have a rally back, because very often when you change market structure from the downside, you will have an attempted rally back. Well, I know exactly where I want to short the Qs if that happens. Right here, 569.10. Why? It's the bearish order block, and then inside of it we have a big down bar, which happened on Thursday. If you have a big down bar and you rally back to halfway of that point, there's going to be inherent resistance there. So you have inherent resistance from halfway of the big down bar inside of the bearish order block. That's my shortable area. But keep in mind, the market structure has changed to the downside. If we rally, personally, I will be looking to short the rally. If we go lower and lower and lower, yeah, I will get long here. So I have two order blocks to make decisions from. Potential buying the high or the low of the bullish order block here, or if we rally, potentially shorting the bottom of the order block, the top of the order block, or ideally, like I said, the 569.10. If we reject that, that's where I would be looking to get short. So not going to mess around with it until we either get higher or we get lower. S&P 500, very, very similar, although we are inside the bullish order block already. So on the S&P 500, we change structure to the downside as well. We have two areas. We have a bearish order block here. We have the big down bar on Thursday, which is at the bottom of the order block. If we rally and reject 635.40, that would be a shortable area for me. But we are already in the bullish order block. Now, I haven't taken action on this. If we reject the bottom of the order block here, the bottom of the order block on the Qs is 618.05. 3 points or so to the downside. Yeah, I could potentially take that, especially on an index. If we reject the bottom of the order block, give me a good risk to reward ratio at the very least. But if we rally again, after you change market structure, there's a tendency to want to counter rally back up. But technically speaking, a lot of professional traders will be looking at shorting any rally. And again, the key level here is 635.40. Last but not least on the dailies is Tesla. All right, well, Tesla has an order block right here. The high is 296.15. The low is 288.77. Right now, we have this 100-day moving average, which is 296.99, right at the top of the order block. So really, that's what I'm looking for. on Tesla next week is a rejection of the 100-day moving average. If we reject the 100-day moving average, we have also rejected the high of the order block. Conversely, alternatively, if it goes down to the bottom of the order block, I could also test there. But first stop, I'm looking for a rejection of that 100-day moving average, which is 296.77. So basically 277. Okay, so those are the dailies that I'm looking at. Let's quickly look at the weeklies and we'll wrap this up. All right, I have talked about Adobe every week for it seems like 27 years. But at least for several months. Here we have an order block. Why is this an order block? Well, we have a swing low, we have a swing high, we have a lower swing low. We break market structure to the upside. When you break market structure to the upside, the lowest bar close before market structure change becomes your order block. We are now in the order block. I was looking for a rejection of the halfway of the big up bar here on 425. I was looking for a rejection of 353. Well, we got there and we closed under, but we did not reject it. Next week, if we close back above, yeah, maybe, but with this big bar, it concerns me. So really about the only thing I'm looking for on Adobe at the moment is a rejection of the low of the order block, the low of the green box. The low is 341.31. So that's still 5.5, 6 points below. But next week, if we do reject the bottom of that and close back in with a good risk reward ratio, I would consider that. Berkshire Hathaway. All right. So this is what I'm looking for on Berkshire. And listen, you hear me talk about relative strength. Look, Berkshire Hathaway was up on Friday. The market got hammered. Berkshire was up. That's telling you something. That is telling you something. It is much stronger than the market because it was able to weather every stock being down and it was up. So that's something to watch. All right, that's something to watch. So on Berkshire, on the weekly, we have a nice order block here, back 110.25. The high is 456.52. The low is 440.10. Move that into the future. Again, people that bought here months later, was that smart money? It was, clearly. It got all the way up to here. People bought here. Well, now we are getting close to coming back to where that smart money area is. So what I'm looking for potentially in the next week or two, it may take a while, is a rejection of the high of this order block at about 456, a low of the order block at about 439. Ideally, if we had an under 30, over 30 inside the bullish order block, that would be ideal. It's hard to say whether we're going to get there or not. It may not get there. It may rally from here. It showed strength on Friday. But if it does come down into here, rejection of the high of the order block, the low of the order block, I would be interested. Russell 2000. Okay, this one's pretty easy. We have a nice big wide order block, swing low, swing high, lower swing low, market structure change, define the order block, the high and the low of the lowest bar close. We have a lot of major moving deep dip by averages inside the order block. Here's the 250, here's the 200, here's the 300. If I get good price action off of any of these moving averages, I'd consider taking the trade off of these moving averages because they're inside the order block. Lockheed Martin, LMT. Okay, so technically 2 weeks ago, this did trigger a legitimate entry because it rejected the 250-week moving average inside of the order block, and it also rejected the high of the order block. I passed on the trade because of the big down bar. If you have a huge down bar that gets you down to your level, I'm not as thrilled about that. I'd rather see the price kind of drip down, move down, move down. But when you have this big skyscraper bar down, that concerns me. Because with this big down bar, very likely if you rally back to halfway, that's why I have the bar here, you're probably going to fail here. So that being said, just to make things simple for the channel, what I am looking for is a rejection of the low of the order block because the 300-day moving average is there. I am all in fine to take that trade. But again, this is a good example of looking at a chart and saying, okay, in a perfect world, where would I take the trade? This is very simple for me. 300-day moving average at the bottom of the order block gives you major moving average support, gives you low of order block support, and an extremely good risk to reward ratio. If it gets there, I'll consider taking it. If it doesn't, I won't mess with it. But again, that 300 level is 398.35. So that's still 23 points below where we are now. Tesla. Well, we talked about Tesla on the weekly or on the daily. We also have it on the weekly as well. Pretty simple. We have a bullish order block on the weekly, and we have this 200-week moving average inside of the bullish order block. This 200-day moving average is about halfway at this big up bar, so that adds bonus points. So on the weekly, if we rejected 255.43, that is what I would be looking for. United Airlines, UAL. Okay. We have a order block right here. The high of the order block is 78.87, the low is 73.05. We have a nice big up bar in the middle of the order block. If you have a big up bar, halfway of that is going to be some support. So really about the only thing I'm looking for on United Airlines next week is if we get down to the 75.6 level, 75.60 level, and reject it and have a nice gentle close above it. So if we come down, go below, close back above, it's going to have to be a gentle close. Can't go below and then close back up here, then the risk to reward is no good. So on UAL, I'm looking for a rejection of 75.60. XLE, which is Energy Select, this one is quite simple. This is, we are inside of a bullish order block, and we have the 200-week moving average at the bottom of the order block. Could not be more perfect. Only thing now is that I have to wait for it to get there. If it does, maybe it doesn't. So the 200 week is at 82.99, so basically $83. So we're $2.60 or whatever below. But this coming week, if we rejected the bottom of the 200-week moving average, we would also reject the bottom of the order block, and that would be a good risk to reward setup. Last but not least, everybody, XLV. I have talked about this for 175 years, and it did not get there, but it may get there now. We have a nice order block on the weekly on XLV between 128.51 and 122.63, and we have the 300-week moving average at 127.78 that lives inside of the order block. So that's what I'm looking for. I'm looking for a rejection of the 300-week moving average next week that lives inside this order block. If it gives me a good risk to reward, I will consider taking the trade. Woo! This has been a long podcast, everybody. Lots of positions and lots of things to look at. But listen, I hope you found it helpful. If I can help you with your trading, please let me know. I coach many people around the world. I teach a great 20-hour course. We'll spend a lot of time together. I'll teach you everything that I know. If you have any comments or questions, please leave them in the comment section. I will do my best to get back to you. But yeah, if I can help you, please let me know. All right. And I wish you a good rest of your weekend. Please be careful next week. Please remember that market structures have changed. This is going to change things. Me personally, I'll be looking to short any rallies. Doesn't mean I'm going to be right, but that's what the technicals are telling me. If you could try to go out and do one nice thing for another human being every day, it would make the world a better place. If you could try to go out and do one nice thing, at least one nice thing for an animal, if you have the opportunity, that would make the world a better place, right? So, God willing, I will see you next week. Again, if you have any comments, any questions, please let me know. I'll do my best to get back with you. But please be careful. Things have changed in the market after Friday's action. All right? All right, everybody. On the way out, I have to run the U.S. legal disclaimer. Thank you very much. Enjoy the rest of your weekend. Take care. Bye.
U.S. government stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.